everybody, what's up? It is Tuesday, March 30th. Tomorrow is the end of the SLR exemption. Remember, we've been talking about that for a long time now. And there have been some dire warnings about what is going to happen after March 31st when that exemption expires. Now, I'll go over it quickly. Of course, last year, in the middle of the pandemic, when the Fed, ramped up all of its extraordinary monetary operations, and with that first stimulus, Trump's 2.2 trillion stimulus, massive amounts of reserves dumped onto bank balance sheets, and the Fed realized that this is going to cause a problem for the banks because all these new assets need to have, a corresponding amount of capital to support that. Otherwise, the banks would have to raise capital or mark down the value of their investments, of their assets. So what happened was the Fed issued a temporary exclusion on the treatment of reserves in the calculation of the supplemental leverage ratio. And now that exclusion expires tomorrow, March 31st. And there's been all this, these dire warnings about what's going to happen. We'll see. And, I've been telling you, and I follow this, so far there has not been any major dump of treasuries. And actually that doesn't even solve anything, because what happens? You sell a treasury, you get a reserve, you get cash. Cash is a reserve asset. So, it doesn't change the quantity of their assets. It just changes the composition. What else could happen? And I don't think, let me just preface this by saying, I think the whole thing has been completely overblown. I think everybody is aware of this, including the regulators. That means the Fed, that means Treasury, that means the FDIC, all of the regulators for the banking sector. I think they're all aware of this because it's been public now for so long, and everybody's been, screaming and hand-wringing about this. So I think the banks are probably in very good shape, but, we'll see. If they have to mark down the value of their asset holdings, that could cause some problems in the markets. But again, I think these issues, the banks saw this coming, and I think the situation is already largely has been digested, and we'll see what happens. So I want to go over, because I've been telling you that the main short position, because I've been talking about the short position in the futures markets on 10-year notes, okay? And I've been saying it's mostly small speculators. They have like a 163,000 net short position, and that's down in the latest week. They were a short 208,000. That's almost 21 billion notional. They're down to 163,000. So small speculators have been covering some of their short position as bond prices have come down. By the way, today, yields on 10-year popped up to a new high. I think we went to 177 and 178, but we closed at 171, which is a little bit of a reduction from the previous day. So who is long the 10-year note futures? Because maybe you want to see, well, okay, Mike, the guys who are short primarily, there's really three shorts in the market right now. They are the small speculators, 163,000 net short. They are the dealers, and I believe their net short might be pretty significant. It might be around 300,000. I have to go back and check. And they are the institutional asset managers. So it's interesting now because you have what normally you would call, I guess, the smart money, the dealers, and the asset manager. And, I'm a skeptic on calling asset managers the smart money, because it generally doesn't work out that way. But anyway, you got the small speculators aligned with the dealers and institutional asset managers. And don't forget, dealers, whatever they're doing in the futures market is probably the opposite of their position in the cash market, because they're using the futures market to hedge, okay? On the long side, who's long the market? It's very interesting. Large speculative funds like futures funds, managed money, they're the ones who are long the 10-year note futures. And you say, well, that can't be good, right? And actually they're long quite a bit, like over 300,000, something like that, net long. You might say, well, that can't be good if they're long, right? What do they know? Well, I'll just, and normally I would agree with you on that. And in many markets, when I see the leveraged funds, the managed money, concentrated one way or another, long or short, I tend to want to go against them. But let me just point out that they were long and flipped to a short position last September, really at the top of the bond market, price and the bottom of yields. They went short at exactly the right time. I mean, they sold the top, okay? And now they're long here. So it looks like, at least in this market, they've been pretty savvy. It may not end up to be that way. I mean, they may end up having to dump that whole long position. But from what I can tell so far, they played this market perfectly. Okay, so they were long all the way up until last September. They flipped short and they had a very substantial short position. They rode this whole thing down, the decline in bond prices, and now they are net long by a pretty significant amount. The other party that is long, the CFTC classifies or characterizes that. They call that other reportables. They don't give a precise designation to that. It's other. That might be these ETFs. I'm not sure what the other category is when they say other classification. And if anyone out there knows what that is, I'd love to hear about it in the comments. But it may be ETFs that use futures as a proxy to, as the underlying ETF instrument. They're long too, but not as much as the leveraged funds that's managed money. So, I mean, we'll see what happens. Look, this is what I say to people. It's really interesting to look at these position breakdowns. And there's a page in my report, or actually 2 pages in my weekly report, where I go over, several different markets. I mean, I go through gold, I go through silver, I go through oil, I go through the S&P E-mini, and I go through 10-year treasuries. It's interesting to see these breakdowns and to see how they shift around, what I call market composition. But let me just warn you, it's not a timing indicator, all right? These position concentrations can persist over a long period of time. And on that note, let me just say, I don't try to time the market. And many people, and you'll probably read somewhere or have already read somewhere, that you can't time the market. And I think I would generally agree with that. But I use time on my side. In other words, I evaluate the situation as to basic conditions, and I manage my money in a way where I'm not over leveraged, and I have patience. That's what I mean by using time on my side. And I know when the market moves against me, that's an opportunity to build a position, as long as I have the correct outlook, and the correct outlook is based on basic conditions, which with MMT, you should understand that, because everything derives from policy. So I don't try to time, but I use time, okay, on my side. Time is an element of what I do, but it's not timing. All right, and I think it's a panacea. It's a false crutch when you say timing is everything, because that assumes you know exactly when things are going to happen. And we all know that that's an unknowable thing, at least in a consistent way. But understanding time and its value and how to use that is extremely powerful. Anyway, that's it for today, and see you guys tomorrow. Bye-bye.